Okay, everybody, this is the video for the lecture for the prologue for your managerial accounting class. So there's some important information in this prologue. There's not going to be a ton of material from it on your first test, but there will be a few things and some major things on it. So I want to make sure we go over it. So first of all, the first thing we talk about here in the prologue is just the differences between financial accounting and managerial accounting. So you probably had this conversation back in financial accounting, which is the prerequisite for this class. But just to go over some of the key differences, let's talk about them. So financial accounting, one of the main differences between financial accounting and managerial accounting is who uses the information. So in financial accounting, if you remember, it's geared towards people and entities outside of the organization that rely on the information. And if you remember, because of that, we have this strict set of rules that we have to follow in financial accounting called GAAP, Generally Accepted Accounting Principles. Again, because the reports and information are presented to external users, we have to have rules that guide us when we prepare that and record information. Managerial accounting, however, is different. So in managerial accounting, the information is primarily used by people within the organization. So we use this word managers in this class, but that really is kind of a very broad word that we use to describe all people within the organization. So they don't have to be technically titled manager. But if we're talking about an employee, a manager, or a department within the organization that needs information, managerial accounting is what provides that information to those people or departments so that they can do their job or make their decisions. Okay? And because of that, because managerial accounting is primarily focused on people or departments within the organization, managerial accounting is not bound by GAAP, right? There's no reason that we are bound by GAAP within the when we present information. Of course, when we record transactions, because we're going to have to present that to outside people, we do have to follow GAAP to record our transactions when we record depreciation, for example. But as far as reporting goes, or the use of the information, we are not bound by GAAP rules, again, because in managerial accounting, the focus is on the internal user, the people within the organization. So some other important differences between financial accounting and managerial accounting. Number 2 here is time focus. And what that means is when we prepare reports under financial accounting or managerial accounting, what's the focus on those reports? So in financial accounting, the focus is historical. If you think about back what you did in financial accounting, when you did an income statement or a balance sheet or a statement of cash flows, it wasn't for a period of time in the future. It was for what has happened in the prior period. So there's always a historical perspective when we talk about financial accounting. Managerial accounting, however, is more future focused. Now, we do use information from the past, of course, but it's to help us make decisions in the future. Another difference, there's these next two, number 3 and number 4. Just kind of look at some characteristics of information and discuss which is more important to either financial or managerial. I would say that they're all important to both, but I guess the authors are trying to get at what's more important. So if we look at verifiability, can we verify the information versus is the information relevant to the decision, which is more important if we had to match them up. So in financial accounting, because again of those external users, verifiability is more important. But in managerial accounting, we're trying to get information to managers so that they can make decisions, and what managers need is the information that's relevant to that decision, right? So relevance is more important in that situation. And then the next group is precision versus timeliness. Again, I would say that both are important to both branches of accounting, but if we had to match them up, again, in financial accounting, because of the external user, precision is more important. But in managerial accounting, because managers are trying to make decisions quickly and in real time, timeliness is more of a concern. And then we have number 5, which is subject, meaning what do we report on in the 2 different branches. And in financial accounting, the primary focus is company, right? If you think again back to the financial statements you prepared, when you did an income statement, it was for the whole company. It wasn't for a part of the company. But in managerial accounting, that's exactly what we're going to do. We're going to segment information, because if we're talking to the manager of Department A, the manager of Department A just needs the information for Department A to do their job. They don't need information for Department C or Department B, right? So we're going to carve out the information that that particular manager needs and give that information to them so that they can make decisions. And then kind of along the lines, number 7 here, of GAAP, as far as requirements for reporting. In financial accounting, we have those external reports we learned how to do, balance sheet, income statement, and so on. Those are mandatory. Managerial accounting, not mandatory. We're going to prepare the reports that our managers need. Okay, so this is an important slide. There'll probably be a couple test questions from this information, so make sure that you take some time to study this. The differences between financial accounting and managerial accounting. Now moving on to the next kind of big topic in here that's important, that there'll be a few test questions about. What do managers do? And basically what we have here are the 3 major activities of a manager according to our authors of our textbook. So the 3 major activities are planning, controlling, and decision making. So let's kind of go one by one here. So planning, we know what planning is. Planning is coming up with a goal, figuring out how we're going to achieve that goal, figuring out the steps that we have to take to achieve that goal. And from a managerial accounting perspective, of course, a very important piece of planning is going to be coming up with our budgets. We have a whole chapter about budgets later on in the semester, but that's going to be really important. So they don't do it here in the PowerPoint, but let's write down the definition of a budget, and just kind of a quick definition of a budget. It's a detailed financial plan for the future. So when we get into the budget chapter, the definition will be a lot fancier, but fundamentally that's what it is. It's a detailed financial plan for the future. So again, the activity of a manager that we call planning is where we come up with the goals for our company or our department, we figure out the course of action, and then of course in accounting terms, a budget will have to be prepared to help us achieve those goals. All right, so the next activity of a manager that's important is called controlling. Now this word sometimes confuses students initially here, because when they see the word controlling used with the word manager, we think of a controlling manager, someone that tells you what to do all the time and micromanages you. But that's using the word as an adjective, describing the manager. But what we're really going to use this word for here is as a verb, right? Because it's an activity. So what a manager is doing when they are doing the activity of controlling, they are comparing planned results, right? What was our plan versus what actually happened, right? What was our plan? Hey, our plan was to increase sales by 10% this quarter. Well, that's your plan, and you set up actions and activities to achieve that plan. But we have to look back at the end of the accounting period and say, well, did we achieve that goal? Did it happen? So that's what controlling is. It's comparing planned results to actual results. Okay. And then the third activity of a manager is decision making. That's relatively straightforward, I think, making decisions. And again, where does managerial accounting fit in here? Well, a lot of times the managers, and again, we're using that word manager as a kind of an overall word for anybody that works in the company. The manager needs accounting information to make decisions. What sales, historical expenses, projected sales, projected expenses. So we as managerial accountants are going to be tasked with providing that to the managers so that they can make decisions. Now the next few slides, I think like 8 or 9 slides or so, go through the different types of planning, controlling, and decision-making tasks that you might need to make in the different areas of the company. Like, so for example, they start here with marketing majors, right? So they are just showing here in this part of the PowerPoint, I know a lot of you in this class are not planning on becoming accountants. But again, we learn in financial accounting, it's important to know accounting whether you're going to be an accountant or not. And so this part of the chapter, this part of the PowerPoint is just showing you if you are going to be a marketer at a company, or you're going to be in human resources or in supply chain management, why managerial accounting is important to you. So I'm not going to go through all these slides individually. You can certainly read those on your own. I will point out to you that there is an exhibit in your book, and I'm getting used to, they changed the way they do the page numbers. So the page number is P3. Actually, I think that's the exhibit number, and it's on page 6, I think, somewhere around there. Again, I apologize. They changed the page numbers on me, and I don't have the book right in front of me, but it's right around the beginning of the chapter. And they have an exhibit where they put all of this in one exhibit. And again, the point is to show you that managerial accounting is important to all business majors, whether you are planning on becoming an accountant, which most of you, again, I know from history are not in my class, or not, right? So again, you can take a look at these on your own. I'm not going to just read them to you. There's no sense in that. So you can read them on your own to get a sense of why managerial accounting is important to everyone that works in business. And we know that already, right? We know accounting is important to all of our business majors. All right, so next I'd like to just spend a couple of minutes talking to my accounting majors in the class. I know, again, there's only probably 3 or 4 of you, but I do want to spend a minute here and just talk to you about what your authors are going through here in this part of the chapter. And if you have further questions about it, you can always contact me individually and we can talk about it. So accounting majors, probably many of you, if not all of you, have heard of somebody being a CPA, right? A certified public accountant. And what I want to talk to you about is that there's different ways that, or different places that you can work as an accountant. And typically they're kind of divided into 2 groups. You can work in a public setting versus a private setting. And actually you can also work for government, right? So that's kind of a third choice. But let's talk right now public versus private. So when you're a CPA, that means you're a certified public accountant. It means you're a public accountant. And what that means is, I'm a CPA. When I worked in industry, I was a public accountant. And what that means is that I worked for a CPA firm. I was an employee of a CPA firm. All my coworkers were accountants and CPAs, and of course the support staff. But what we did is we went out and did accounting for other businesses. So I worked for a CPA firm. It's called Matz and Sapp. They're not in business anymore. Matz and Sapp, certified public accountants. And what we did is we had clients. So I would be the auditor for ABC Construction, and my coworker would do the tax return for XYZ Distributing. So we did accounting for other businesses. That's what it means to be a public accountant. You work for a CPA firm. I think when I went to school there was the big 8 CPA firms, but now I think it's down to the big 4 CPA firms. But what you do is you work as an accountant at the CPA firm and you do accounting for other businesses. Now, if you see here, it says that about 80% of accountants that are out working work in non-public accounting. So that means public accounting make up about 20% of the accountants out there doing work, but non-public or private accounting is about 80%. And what that means is that, again, I was a public accountant. I went and did the audit for ABC Construction. But at ABC Construction, there were accountants that worked for ABC Construction. So that's what it means when we talk about non-public or private accounting. It's the accountants that work at the businesses. And a lot more accountants in the field do that, are the employees of companies like ABC Construction, than work for CPA firms in public accounting. So I just want you to be aware of the differences. And just so you also know, everyone again is typically aware that you can be a CPA and have take a test and be licensed as a CPA. But if you work in non-public accounting, you could also get a license or a certification called a CMA, which is Certified Management Accountant. So again, depending on where you end up working, you might have one or both of those. So again, I know that took more than a couple minutes, but I did want to just mention that to my accounting majors in the ether here, in the video. And if you have any questions about any of that, please feel free to ask me, in email or, however, during office hours, please feel free to ask. Okay. So if you want to read a little bit more about it, they have a little bit more information here about the CMAs that you can take a look at, again, for my accounting majors in the room. And the next area we get to in this chapter, in this class, starts to talk, and we're not going to spend a ton of time here, but talks about the purpose of this course. But it also wants to mention to you something else that's important. So first of all, the purpose of the course. So the purpose of the course is accounting, right? So the purpose of the course is to teach measurement skills, right, to business majors, right, who are ultimately either going to become accountants or function in business, as a manager, to help support you in your planning, your controlling, and your decision making. So that's our focus, of course. We are I'm sorry, I think there was a little gap in the video. I thought I paused it, but apparently I didn't, so I apologize for that. So, of course, the purpose of this course is managerial accounting. Our focus throughout the semester is going to help teach you measurement skills to either be an accountant, of course, or to work in business. But our authors also want to mention to you that it is important that in addition to having measurement skills, right? In addition to having these measurement skills that we're going to learn here, it's also important to have management skills, right? And we're not going to teach that in this class, right? We're an accounting class, so we're going to teach the measurement skills. But we do want to mention to you right at the outset here that it is important that if you're going to be a manager in a business, that you also, in addition to have measurement skills, have management skills. So the next section of the chapter here, they talk a little bit about management skills, right? They talk a little bit about management skills, and in the context of these different areas, ethics or leadership or process management. So I'm not going to read these slides to you. I would say that I would recommend that you read this section of your book. There's not going to be any test questions about it, but I would recommend you read it. Everyone's a business major in here, so maybe take a look at it. And if you have any questions about it, feel free to ask me Again, either in office hours, in the discussion board, however you want to do that. There are a few things at the end of the chapter, though, that I do want to point out to you. There's some things that are introduced here in chapter 1 that we will see in later chapters. So I would like to talk about them here just to give you an idea of what's going to be coming down the road. So before I talk about this slide here that we're looking at, and by the way, I'm on slide 39 if you're following along. So what I need to mention to you before we move on is what the primary focus of this class is going to be. So if you think back to financial accounting, when we did work in financial accounting, we were a couple of different types of businesses, right? In financial accounting, in some of our problems, we were service organizations, right? We provided service, we washed cars, we mowed lawns, we gave flying lessons, we were dentists. And then in chapters 5 and 6, we were merchandisers, right? When we did our inventory chapters, we were merchandisers, right? We bought goods that we then resold. For the most part, in managerial accounting, we are going to be dealing with the accounting not for service organizations or merchandisers. We are going to be dealing with the accounting for manufacturers. Okay, so in managerial accounting, the primary focus of most everything that we do is going to be for manufacturers. And manufacturers, as I'm sure you know, are the organizations that build things, that produce things. So most of what we cover in this class is going to have to do from the perspective of manufacturers. So this next part of the lecture here talks about some things that are specific to manufacturers that I want to go over. And again, we'll introduce them here and we'll see them later on in the class. First thing, what we're looking at here on this slide is called the value chain. And what the value chain shows us is just that when we're talking about a manufacturer, the end result of a manufacturer is that they're going to produce something, whatever it is. It's a table, it's a car, they're going to produce something. And so when we look at that, we want to make sure we understand all the steps in the chain that went into this production and the support of this product for this manufacturer. So it starts with what's called R&D, which stands for research and development, right? So people in our organization are going to research and develop what we think our product should be. Then it gets designed in the next step. Then it gets manufactured, and this is where we're going to spend a lot of time talking about the accounting for manufacturing. But then after that, after we manufacture it, we also have to market it to the public, we have to sell it, we have to distribute it, and we have to provide customer service. So a manufacturer's job is more than just the manufacturing. So that's what I just wanted to point out with this slide here, is that there's more to it. Okay, the next thing I want to talk about in terms of manufacturing is that there are different ways to approach the process of manufacturing typically in a company. There's what we call traditional manufacturing, and sometimes traditional manufacturing is called push manufacturing. And what happens in traditional manufacturing or push manufacturing, this slide's a little misleading. It has at the top here lean production, right? But this slide's about traditional manufacturing. So what happens in traditional manufacturing or push manufacturing is that the company decides what they want to sell. They decide how much of that thing they are going to produce. They produce it and then they push it out to the market. We have all this inventory that we just produced, and we say to our salespeople, go out and sell this. We're going to push it out to the market. So one of the problems that can happen with push manufacturing or traditional manufacturing is that maybe you don't predict what the market wants very well. Maybe you end up with a product that nobody wants. You end up with goods that you have to store and then try to sell at a discount. So there's a risk, of course, to doing it this way. If you don't predict what the market is willing to pay and what the market is, how much of the product that the market wants. So we have an alternative to traditional manufacturing. And the alternative to traditional manufacturing goes by a few different names. It's sometimes called lean manufacturing. It's sometimes called pull manufacturing, and it's also sometimes called just-in-time manufacturing. So this is the alternative we have to the traditional way of doing the manufacturing. And what happens in lean manufacturing or pull manufacturing or just-in-time manufacturing is the company kind of waits. The company waits until there's a reason to do something. So the way it kind of works is that we wait until we have customer demand. They place an order, we create a production order, we get the components that we need for production, and our goal is to have the components come in just in time to get the production going. And we want production to finish just in time to get the goods shipped to the customer by when they want them. So our goal with lean production or pull production or just-in-time production, basically our goal is to have no inventory sitting around. In a perfect world, what we would want to have happen is we want the components to come in one door of our company, go to the factory floor, go into the product we're producing, and then when the product is done, go out the other door to the customer. So we are never warehousing any raw materials for production. We are never warehousing any finished goods that are waiting to go to the customer. Now that is in a perfect world. That does not, typically happen. There is going to be some inventory that has to be held by the company, but that's the goal. Now, the benefits of this, of course, like we were just saying, it allows production to respond to customer orders. Our units produced tend to equal the number of units sold. Because of the way we do this, we have to be very careful with quality. So we want to make sure we have fewer defects, less wasted effort, and we have quicker customer response. However, there is or could be a downside to this lean production or just-in-time production because, oops, I spelled that wrong. In lean production, the customer is very, very vulnerable to disruptions in the supply chain. So, for example, if something happens with our supplier of bolts and we can't get the bolts we need, well, then our production grinds to a halt, right? So we're very vulnerable to any kind of disruptions in the supply chain, and we have to have really, really, really good coordination with our suppliers in order to make lean production be effective. All right, so that is the end of the lecture for the prologue. You do have a couple of questions that I assigned for homework. I'm not going to do a video to go over the questions. You can just read the answers to the questions and the solution. But if you have any questions, make sure that you ask them and let me know. All right, I'll talk to you later. Bye, guys.